He's definitely set up the mood here. Awesome.
That is the caller.
Okay.
I like the upbeatness of it. Because trading options is fun.
Wow. We're at 10:30, hit about 35, reaching there.
Very upbeat music, Mitch. Very nice.
Yeah, we got 33 in. I guess we'll start.
Fantastic.
Yeah. Folks are joining in. Let's get started.
So your website is ProfitMakers.trade?
Yeah, that's our Discord channel. We communicate on that Discord channel. So we're kind of in there.
Beautiful.
Yep. And it's kind of a exciting opportunity. And we actually got on there recently. Leon brought me on there. Until then, we were using our old-fashioned WhatsApp. And Discord's the new thing now. So that's where communities are hanging out, especially after COVID. So we kind of formed our Discord channel there.
That's great. That's
Cool.
great.
Okay, I'll go ahead and get started with the intro. And I'd like to go ahead and welcome Dr. Data here today. In my opinion, and I'm not trying to brag here, Dr. Data, like we watch you very closely on TastyTrade, and we are impressed with the level of analysis you and your team put together at TastyTrade. Everyone here, I would say most of the folks that are here are Tastyworks fans. We all trade on Tastyworks. We're impressed with what you put out there. I love data, and I love doing back tests. So it's a privilege and honor to have you here at our club meetup today. And
Well, thank you,
I'd
Peter.
like to also say that we do have a little membership here, but we keep our membership here for the active and the most committed traders so that we can serve the community. So whatever we collect in our dues as a part of our club, we go ahead and donate it to hungry people in Dallas.
Oh, that's great. That's great.
To serve the community. So we've been privileged to do that in this community here. So we welcome you here, and we're here to hear some words of wisdom from you. Any new stuff that you have on your belt, and I'd like to also open it up because everyone has the privilege of seeing everything on TastyTrade. I'll cut it pretty short, and once you're done with sharing your insights, I'd like to open it up for the folks here to ask you any specific questions or personal questions they have to ask you about your journey in this process. So welcome on board, and I'm glad to have you here. Thank you.
Well, thank you. Thank you very much. And I appreciate being asked. It's an honor. I appreciate being asked. And, the generosity that you guys are doing as far as feeding the community of Dallas, that's great. That's great. So I applaud you guys for doing that. So, let's just open it up to questions if you'd like. We can just talk about what's on your mind, and we can kind of go from there.
Sounds good. So there were 3 questions that we had kind of gathered together, and they're pretty high level. I'll bring those up first, and then just go ahead and go into the details. So the three questions I'm just going to kind of hit on is any latest findings and research that you have been working on and you've discovered in that aspect. Have you noticed any new consistent income research trades you have kind of seen in your data analysis?
Mm-hmm.
And then are you using any new indicators to increase the probability of profit? Are you seeing anything new out there when you're tackling through all these tools? So those are the three high level questions. You can kind of tackle it however you want to.
Okay, sure.
Then, yeah, go ahead.
So I think one of the things that I'm proud of within TastyTrade and the TastyTrade research is that most of our research is pretty consistent, you know, when it comes to the findings. We're looking for, once again, and many of you guys know that, is that we're looking for stocks with higher implied volatility. When you have higher implied volatility, it's not so much that your probability of profit increases. It really doesn't. There's really no greater probability of profit when you're looking at a stock that has an IV rank of 90 versus 10. The probability of profit is roughly about the same. It's just the return on capital can be much, much greater. And so that to me is one of the biggest kind of confusing aspects of things, and a question that we get asked a lot of. So around the election, and this is one of these situations where there's a lot moving right now, and there's a lot of uncertainty within the market. But the uncertainty of this market has definitely been a collapse in the volatility. Especially look at the bonds, and the bond volatility has just really just dropped off. Because if you look historically, when it comes to elections, usually bonds are some of the biggest movers, biggest asset class that makes a huge move. And there was a little bit of a jump there with volatility, but it's definitely come down. And so the decrease in the volatility is dropped by a third. And so that was a really interesting play. Now, at the same time, TLT which is the bond ETF, there's not a ton of premium in that particular trade. It's got a relatively low implied volatility, and so therefore low expected movement. And so the opportunity there has been, it was a nice opportunity, but the profitability of that particular trade wasn't enormous, because even though it decreased as we thought it would around that event, the elections, it has the profitability of that particular trade is still relatively low, just because it has a low implied volatility. So to me, it's one of the biggest things that I'm looking at is I'm looking for stocks that have a high implied volatility rank. Not because the probability of profit increases, it really doesn't, but the return on investment can be considerably greater. But at the same time, looking for stocks that have higher implied volatilities. So you have high implied volatility rank, and then also a nice combination between high implied volatility. So you need high IVR and high IV in order to have that extra bump in profitability. And so that I think is one of the biggest takeaways that I would say from our research that we've done, is look for ideal combinations of both right now. Right now, for example, the biggest implied volatility, the biggest combinations between IV and IV rank is the metals, SLV. It's got the highest implied volatility right now. You look at some of the oil stocks, huge implied volatility, huge implied, and the implied volatility rank is also high. And so you don't need to just look at IV rank, you also need to look at IV. And so that is something that I would always say, look at. Focus your eyes on these stocks that have the high IV and high IV rank. And if you aren't subscribing to Cherry Picks, subscribe to Cherry Picks. That's the newsletter that comes out on Tuesday afternoons, and I'll oftentimes focus on those stocks that have ideal combinations of IV and IV rank.
Yep. No, this is good. So just to kind of execute those high IVs, I've kind of used the philosophy of one standard deviation out, and that kind of process. What are you seeing now as far as when evaluating data? Are you still seeing that one standard deviation seems to be holding true in these environments, or should we be going further out, getting less deltas out?
Well, right now, unfortunately, there's a look at IV over the past year. We had this huge spike in IV in March and April because the Corona, and of course the decline in the market there where we had dropped an enormous amount, and so we all of a sudden had this huge spike in implied volatility, and that kind of in some ways messed up the IV rank calculation. So even though you do have relatively low IV ranks across the board, it's still our current level of IV is much, much higher than what it has been in the past. Historically, going back multiple years, it's still some of the highest IVs that you have on record. And so if you look at just your typical stock, you're still seeing implied volatility right now that is still 85% higher than it's been over the past year. And so when you do have implied volatility that high, if you have a stock, now I'm talking about IV itself. Does everybody understand the difference between IV and IV rank?
Yeah, I believe a few of the premium members, let me see, can you give me a thumbs up if you understand IV rank?
I know IV, but I'm not sure what IV rank means.
Sure. So let me pull up something here, if I could. I'm going to bring this down here, and I'm going to share my screen here. Give me 1 second. Just so I can kind of give a nice looking visualization of things.
Yeah, and while you're pulling that up, Michael, I have a question. So you mentioned the higher volatility this year, and I know a lot of people I know have realized that as well. I guess that's primarily because of the COVID and then stimulus shocks.
Yeah,
that adds to it.
I'm sorry, continue. Yeah.
Oh yeah, I was just asking like those two major events kind of contributed to it. So the COVID pandemic shut down business, the correction, and then the stimulus that's getting injected.
And the election.
Oh yeah, and the election.
There's a lot of crazy stuff going on right now. It's an unusual time. It's an unusual time, and now we have in the United States we have this peaceful change of power, and so that of course, as new thoughts get played out into the political realm, that is of course uncertainty. So let me show you here. So what I'm looking at here is this is a back end that we've created for the research team. And this is something that we use internally as a way of visualizing graphics that you see within the research team, and that you see within segments. And so we have a back tester in here. These are all different things that I've built over the past 6 years, just one little piece at a time. And so if I'm going to just plot a couple different things here, I'm going to plot, like, for example, the S&P right now. Okay. So if you look at implied volatility of the S&P 500, okay, so we're down to, let's say, over the past year, actually it looks like it's a little bit more than a year here, how many months do I have here? Okay, let's just go it back to exactly one year. So I'm going to say 1107. Okay. Okay, so this is the S&P 500. Okay, this is just the implied volatility that you're looking at right here. And now you can just disregard all this programming stuff here. This is kind of dorky, but how we would create a slide out of this is we would just kind of drag and drop this to a slide, and that's what you'd see on the show. But I'm just kind of showing you the back end here. So this is the S&P 500. This is the implied volatility over the past year. You can see this huge increase in implied volatility, but you can still see we're really a lot higher than we've been in the past, going back several years, even though in the past several months, we're kind of relatively low at where we've been. So IV rank is just a way of saying where we are in comparison to where we've been over the past year. So if you are the lowest you've seen over the past year was like in January, okay, we're all just living in ignorance, ignorant bliss, you know, of nothing going on in the world. And we had this very, very low implied volatility. And then all of a sudden we get news about the coronavirus, and all of a sudden the implied volatility starts to increase. And then all of a sudden the market starts to take this in. We start realizing that this is not just the normal flu. This is not going to go away. And then all of a sudden implied volatility, or you can just call it volatility, starts increasing. So as the market drops, you all of a sudden have implied volatility of 80%, meaning, or what this is basically saying is that the insurance that you were paying, and if you were paying, let's say $10 for insurance, and all of a sudden it's 8 times more expensive up here. So if you're paying $1 for insurance, and all of a sudden you're paying $8 for insurance against a move. That's basically what implied volatility is. It's a linear expectation of movement. So if you have a stock with an implied volatility of 40 versus an implied volatility of 80, that stock with 40 is half as expensive as far as the insurance that you're buying for it. The calls and the puts are half as much. Dollar for dollar, generalization, it's half as much as that stock with an 80. Now, of course, it's different across the different parts of the curve, but let's just say it's half as much. And a stock that has a 200 IV is going to be twice as expensive as one with 100, or 4 times as much as a stock with an IV of 50. Okay, so IV rank is basically just saying where we are in comparison. So right now, for example, in SPY, we have an 18.8. This is the platform. This shows 18.8. Let's just round it up to say 20. Okay, so basically that says the point here is 20% between the low and the high that we've seen. 20%. So it's 20% between the low and the high. That's all IV rank is. It's saying we're in the 20th, the bottom 20th percentile of movement between where we've been and where we are at the top. Does that make sense?
And just to add to that, that's at a 52-week rolling, right? Pretty much.
That's a 52-week rolling calculator, right? Now you can always mess around. There's nothing magic about that. We can say, let's go back to 2018 or 2017, for example, and I'm going to just plot that. Okay. So if you were to look at this here, what would we be? Well, we'd still be relatively between the low. The low wasn't all that much lower than where it's been, but we're still within probably, well over 80% where we've been. So this is what you call percentile, right? So as far as things, sometimes it's just this very, it's with statistics, you can oftentimes get paralyzed by having too many numbers within your face, by having too many outcomes, too much analysis, paralysis by analysis. It can sometimes happen when you're looking at too many numbers. And so that's one of the reasons why we've only kind of gone with IV rank. But if you wanted to look further at the number, you could still say that even though our IV rank is really quite low, historically, it's really high. There's still a lot of opportunity in this market as far as things are concerned. As far as making money within this market, this is the type of market that you want. You know,
Yeah. So
have uncertainty.
ask you a follow-up on this. So as we can see, like we got this like crazy IV going on. And so you could say like the past decade before was probably more of a, you know, more safety on the selling side and buying side. You have to have really high conviction. This year, however, if you're right directionally on the buy side, I mean, I can tell, like I've had, and I know a lot of people have had like insane gains on the buy side. So
Absolutely. Absolutely. There's a lot of opportunity right now. I mean, historically, because of the, now, even though the market has been going absent this recent period within the past 7-8 months, we've had some declines and now we've gone back up. And so back in March, had you bought and then held till today, it would have been an enormous gain. But had it's oftentimes you can, it hasn't always been very ideal for traders because the market going back, let's say 5 years, because it's just gone kind of straight up. There hasn't been a lot of two-way action is what you say, right? And as traders, you kind of want that two-way action. You want a position where, okay, let's say you get short and then the stock keeps on going against you. You want to be able to have some type of action where if it just keeps on going against you, that's really painful to all of a sudden buy at much higher levels. You kind of want to wait for a little bit of a pullback. That's what you call like two-sided action. The NASDAQ, for example, where the NASDAQ saw that huge gain in the market, that was not two-way action. Of course, but what you're seeing right now where the market's kind of gone up and then it came down and then it gone up and there's a lot of choppiness, that's definitely what you call two-sided action. But historically, if you wanted to find better opportunity, you'd go like overseas. You'd look at the emerging markets ETF. And let me show you right here. If I wanted to plot this emerging market EEM, you can see that the volatility in EEM historically has always been much higher than the US. But look at it right now. There's actually, and this is what I consider kind of crazy, is that the emerging markets, which you know what the emerging markets are, is emerging markets are pretty much any developed country, that has a pretty stable economy and a market associated with it. So we're talking about.
Will that include China, Mike?
Yes. So China used to be a very small part of the emerging markets ETF. And there was about a rebalance done here within the past maybe year and a half, where it increased its sizing component of it. So it's basically like it's Mexico, it's China, it's Brazil, Russia. It's got India in there. These are all the emerging markets. And so if you look at it historically, if you wanted to get action, you don't go in the U.S. If you wanted to trade, you go to the emerging markets because the volatility was much greater in the US. There was more opportunity, is what you'd say. Lately, there's more opportunity here in the US than there is any place else in the world, pretty much. It's not in China. It's here right in the United States. If you want to trade international, you don't have to go overseas because the Dow, 50% of the Dow revenue is international. If you want to trade international, you trade the Dow stocks. Maybe some people would say they're a little boring, they're a little big, and so therefore the bigger the size of the company, the little slower moving it is. I agree that is true, but your reward is going to be in relationship to the risk that you take also, right? Many of these Dow stocks are as big as countries, and so these are enormously big companies. But look here. Like I said, in the past several months, there's more and there's a higher level of implied volatility in the US than there is in the international space. Now, there could be an argument made that perhaps we haven't done as good of a job when it comes to some of the outbreaks of the corona. Even then, that's debatable. And I'm not taking an opinion on that at all, because I think it's what's the point? But the movement is here in the U.S.
Yeah, thanks for that.
Mm-hmm.
So
do you foresee the volatility reducing now that the election is behind us?
Oh yeah, no doubt about it. No doubt about it. And actually I wrote a program here to do that. Let me see which one I can just show you as of. I'm sorry for using this as like a crutch, but I kind of feel like at the same time some people would find this kind of interesting here. These little programs that I've written. I've written hundreds of these programs here to look at different events before and after elections, and so
I think there are many programmers here, so we don't have a problem with that.
Good. Lots of nerds in this group.
Yeah, so I don't think this group is afraid of code, so you can feel free.
Okay, good. Yeah, I consider myself definitely a working engineer. You know, it's I'm not a I'm a working engineer. I definitely do a lot of programming. Vast majority of my day is spent programming on things. So look at this right here. This is kind of interesting. This shows you let me move my little window here of people. This shows the S&P 500. Okay, this is last year and this is 2020. Okay, so you can see the movement liked that news. Now, did they like the news because Biden is winning? And it looks like it was called, but whether or not that's gone through the official process, I don't think it's quote official quite yet. But or is it because they like gridlock, which traditionally the market has performed pretty well in gridlock, because that means that nobody can mess things up because nothing will get done. You know, you can't have a president do one thing and you can't have the Senate get anything done either. So it's pure gridlock right now in this type of situation, and perhaps that's why the market is moving. Let me show you this VIX here. This VIX after the market, because you brought up an excellent point. This is what happened right after this election. It's what happened in the 2016 election. It's what happened after the 2020. This is the VIX. You know what the VIX is? The VIX is the implied volatility of the market. So it's completely directly opposite of what the S&P 500 does, right? So if the S&P 500 goes up, most of the time the VIX goes down. And if the S&P 500 goes down, volatility goes up because uncertainty drops. Sometimes it's called the fear index, right? The fear gauge. VIX is the fear gauge. And so there was all this uncertainty. Oh gosh, what's going to happen? Well, I wrote about this in the last cherry picks, and I said it's kind of like it's like you're looking at an earnings trade. It's like looking at the biggest binary trade in the world, right? Where you had all of a sudden all this uncertainty around an earnings. In this case, we had an election, came out, and it got sucked out. All that volatility, all that uncertainty got sucked out. Okay, so what's going to happen? Well, we have Senate, and then the presidency, opposite parties. It's not too bad, you know. So,
which is again gridlock, right?
That's gridlock. That's gridlock. Nothing can get done.
Nothing can get done. Status quo.
So, it's and so whatever, nothing big can get pushed through. And you know, I am one of these believers that anytime you try to have something big push through, that creates uncertainty as far as what happens within the market. And I tend to like, I like uncertainty because I trade options, but at the same time, I also believe that uncertainty is long-term uncertainty is not good.
Dr. Data, I was gonna say, do you have a chart for what happened with COVID? Because we're all watching for a potential like second wave and what could happen if there is another rise up per se, or vaccine.
Sure. I mean, look at that's what I would say right here, and it's kind of hard because I don't have anything in particular related to COVID as far as some of the news, and it would be kind of interesting to look at the numbers and how they've grown, but there's definitely a lot of uncertainty within that entire space right now. What is the you brought up a good point. What is the biotech ETF? What is that called? XBI?
Anyone here?
Yeah, XBI. It's right, Mike.
Okay.
XBI.
Okay. So
XBI.
thank you. So let's look at that little stock. Let's not go back too far. Let's just do it beginning of the year. Okay. So this shows you XBI, and here I'm gonna just make this black. And hopefully there's nobody colorblind here. I think it's pretty much just moved with the overall market. You know, it doesn't seem to be huge amount of, I mean, yes, of course the uncertainty is greater, but uncertainty has generally been much greater within the biotech ETF as a whole. The biggest spread, or the smallest spread difference that we saw was in March and April. And that, of course, had to do with the overall market was declining by quite a bit, but the biotech ETF was not declining by nearly as much during that drop in April. But still,
Mike, I have a question here.
Of course.
So when you say the VIX is going down, volatility goes down, does that mean that the premiums are degraded? So let us say there is no binary event in a particular underlying. There is no earnings coming up. There is nothing else going on. So when VIX is down, is it fair to assume that the premiums are relatively lesser, right? Isn't that a standard assumption that I should have?
Absolutely, 100%.
Okay.
And I shouldn't have said 100% because as a general rule, that would be true. However, IV is not perfect across all parts of the curve, right? Of the chains. So if you're looking at, let me just pull up. A little. I'm going to pull up a note here, and let me just say right here. If you have two stocks, okay, you have one stock, let's call it ABC, and that has an IV of 20, and then you have XYZ. Oops. Okay. And then you have XYZ, and this one has one of 40. This one will be 2 times as expensive for the puts and calls because your IV is greater. And IV is, and we can look at this when you're looking at 2 stocks. So what did I say? And if you want to look at what the IV is, This is where your IV would be. So if you're looking here in XBI, and this is a 35 IV, okay? Now you look at something kind of boring. Boring's not bad, and you have XLP, that's Staples. Staples right now is 20, okay? Now let's look at XLE, that's 40 right here. So, and these stocks, they're about relatively XLP 65. Okay, so dollar for dollar, this thing, if you're looking at the exact same levels of the stock price, and if you could think of two stocks that have pretty much the same stock price, I could show you on this graphic. But if you're looking, this one here, this has got a put at the 65. This is at the money, and this is $1.48. So let me show you here. It's going to be $1.48 and the price of the stock. Okay, so it's about 2.2%. Okay, that's how much that premium is as a percentage of that stock price. Okay, now let's look at XLE. Okay, this is twice as expensive right here. So let's look at this stock here. And so here we're looking at $1.07 and the stock price is 28. $1.07 and the stock price is 28. So see, look, it's here 2.2% versus 3.8%. So it's about double. And that's just because the price of the stock or the price of the stocks are different, but that's why I'm using the percentages. And so the amount of premium in it, the amount of insurance, which is the calls and the puts, they're twice as expensive in XLE as they are in XLP. And the reason why I was doing that differential is just because the price of the stocks are different. One is 65 versus 28. But that's why I looked at the
double the IV, double the premium.
Double the premium, yeah, that's right. Mm-hmm. That's pretty much a rule that you can look at. And so that's one of the reasons why in cherry picks, and this is kind of a small thought, but it has kind of big repercussions, is that I'm gonna show you something here. This is a visual that I do for cherry picks, and oftentimes you've seen it in cherry picks. And so what I'm going to look at here is just I'm going to plot this out. Put this on white. And so just look at this little graphic right here. Okay, so if you look at it, this shows you the IV at the bottom, and then it shows you the IV rank at the top on the side, right? So as you go further to the right, that means it's more expensive premium. The premium is more expensive. The volatility is more expensive. Dollar for dollar, you're going to get paid more money for OIH over here on the right than IEF. IEF is like a bond fund. It's kind of boring. It's like 5 versus OIH, which is 60. Okay, so let's look at that like right now. Let's look at the difference here. Get this little
I'm actually liking that SLV up there.
I know, right? Okay, I need to. I got stuck on my Oh my goodness. Oh, okay, here we go. IEF. Clear the drawings. IEF. Okay, look at this. It's a $120 stock with a 60 cents. Okay, so if let's just do the math here. Okay, 60 cents over $120 stock. That's 0.5%. That's 0.5% is how much you're going to get paid going out 41 days. Annualized, what is that? Okay, 41 days and 365 times 0.5%. Oh, no, I said that backwards. I'm sorry. How many times can you put 41 into 365? So ideally, you could do this 9 times a year, right? If you did this with 41 days till expiration, you follow my thought process here.
Yeah.
So if you multiply this times 5, so you're going to make 4.5% if you were to do this strategy, and you were to make 100% of the money, you're going to make 4.5%. Is that worth it? It's not worth it to me. So to me, this is not a stock that I'd want to put. I'd want to do this with if I was doing a cash secured put, because I'd have to put up enough money in order to do the strategy. And it's not worth it. You're not going to make a good amount of money on this. However, let's look at XLE. Is that what you just said, XLE? So here, let's look at this one. Okay, $1.07. Let's call it $1.10 for 28 cents. $28. So $1.10. And you do this. Okay, so that's 4% going out 41 days. So, and then 365 into 41. That's how many days you can do this per year, let's say. So annualized, this is 0.039. That's 35%. That's a 35% possible return on capital if you were to make 100% of that money and you were continuing to do it 9 times. So one, you're looking at a trade that has an IV of 6 and another one with 60. You're going to make a lot more money with this strategy than the other if you were to do it correctly. So one of the things that we say when we're doing strategies is, and this is what I like to do personally when it comes to looking at and evaluating trades, is I say everything, let's just consider the world perfect, right? You only have a finite amount of money. That money can be used in a number of different things. So what can you put your money in? Well, you can put it in a rental property. You can put it in gold, you know. You can put it on your bed. You can put it under a lot of different things. And the risk should be appropriate to the reward that you get. In this particular thing, in these two particular trades, your IEF versus XLE, you're going to have a lot more risk within your XLE as your IEF, but also your potential is going to be a lot greater in this one. So let's say that this is 0.37. Let's say you keep 25%, which is a pretty normal, that's a pretty conservative number. So if you can make 35% annualized return on investment, and you're doing a strangle, and you keep 25%, that's making 9% return. And that's a pretty realistic return on an investment for a strategy like this. And this is just selling a put, which actually has a higher possible return on investment. Yeah. You can't make 9% in the market right now. So, well, unless you perfectly do things, but this has a pretty good return on investment, and this has a pretty high probability of profit.
So the 9%, would that be your monthly target per month? So I was curious if what your strategy is. Is it you aim for 10 to 20% kind of monthly, quarterly with selling premium?
Oh God, if I could make 10% a year or 10% a month, you know, it's like, why am I doing anything else but trading, right? No, I think that's unrealistic. I think for things, I would like to make, and once again, I think that, you know, we have to be careful when we're looking at investments. Look for things that are suitable for the level of risk that you're willing to take. So should you make, sometimes it becomes very difficult when people ask, well, what strategy should I do? What strategy makes you comfortable? What is the best strategy for you? And what, you know, for example, if you have two different accounts that you're looking at, and one account is 100 million. This, I'm going absolute extreme, but one is 100 million, and you're looking at a 65-year-old woman, and And then you have another account that is $10,000, and you have a 65-year-old woman as well. Well, the $100 million account should not be taking as much risk. What's the point? You know, you don't need to make 10% a year with 100 million. I mean, unless your lifestyle is a Kardashian, and you don't need to make that kind of money per year. You can 1%. My God, you'd be doing pretty well. You beat inflation, and just barely, but you'd be beating inflation and be living pretty well, as opposed to somebody that is $10,000 in their retirement. And they want to have a nicer life, and they want to live in New York City when they retire. They need to take a lot more risk in order to obtain that lifestyle that they want to live.
Mike, I thought we all are aspiring for Kardashian lifestyles. Yeah,
I am.
I know, that's what I'm shooting for.
That's not a strategy question. And then I think Mitt had a question.
Mm-hmm.
So on with buy side and sell side, are you like 90% sell side, 10% buy side, or does that really kind of change depending on the IB on the year?
Generally, so you mean not buy side, sell side as in market maker, but more as buy or sell versus options,
yes.
Initiating positions. Yeah, I will almost exclusively do. I'll sell to open, so I will sell positions to initiate. So I will do premium trades. However, that doesn't mean, though, at the same time that I'm going into this without any thought as far as the risk involved, or that doesn't mean also that I'm not capping losses as well. Like, for example, one of the things that I'll sometimes do is I had a pretty good trade here going for several years until just recently, and it was silver. I was getting involved in silver a lot. I was doing a lot of silver. And when I looked at my portfolio, it was most of my, equity positions was well, I mean, most of the equity positions were like the S&P 500, but then, and then I pretty much had it like in SPY and IWM, and then the rest was pretty much in silver, SLV. And I was doing some like very, very boring trades where I was just buying SLV. I was just taking positions in it. And then I would sell, and I was just buying the stock outright, and then I was selling calls against it. And for the most part, I would have it, maybe it depends on where it was within the process, but sometimes I would have pretty big losses in it. But I wasn't selling a lot of calls when it was down low, right? So I was maybe only selling 3 for every 10 that I had. I was only selling 3 calls to every 10. Then when it got up higher, I'd sell maybe 6 for every 10, and then it would get up higher, and then I would all of a sudden, and then it all kind of fell apart, and I ended up basically scratching this year because it went up a little too high, and I got short more than what I was. So I was just short calls with, I had covered calls, but then I had more calls than I had positions. And then the stock just kept on going against me. And then I was getting shorter and shorter. And then I started to have a big loss. And I had a really nice profit at the beginning of the year until started going against me. But another thought, and I really haven't answered your question fully, but iron condors, right? That's a pretty nice combination between sell and buy, right? I like to think of it as I'm doing a strangle, but I'm capping my losses. So I'll say, well, okay, I'm doing a strangle, but I'm capping my losses. It's an iron condor. And so I will do that pretty often, especially in my work account where the account is not as big and I'm kind of afraid about losing more money than I don't want to have to answer to my boss for it. And so in my own personal account, I most of the time will do just almost exclusively just short strangles. or I'll do cash. Basically, I think of it as a cash secured put oftentimes. I will do, but I have a margin account. But I will do naked shorts, although generally not as much. Just mainly because I've been fairly bullish about the market. I don't always take the concept that we always have to be short within the market. We always have to play from the short side. When I mean short side, meaning you have to be short the overall market. I don't always believe that. However, sometimes I think it's mistaken when people hear Tom telling, he's playing it short. He's not always talking about playing it short as in he's got these tons of short deltas on. He wants the market to drop. Oftentimes that just means that he's short as in he's short options around it. So he could say, I'm short the market. It's not necessarily saying that he's short as in he wants stocks to decline. A lot of times it just means that he's short a put. And so sometimes if you listen to him, it can get a little confusing, but don't always perceive that as being he's always short the market, because he's not always short the market.
So is that, especially being contrarians, I thought when it keeps going up and up, we hear Tom saying, I'm short, but that's how I always understood, like you just said, when Tom said I'm short, so I always thought, okay, he's a contrarian, it's going up and up and up, up, up. So he's trying to pretty much say, okay, this bull run is done and I'm ready for the call down. But when you say he's short a put, doesn't that mean he's long essentially?
Yes, but he's also he's short the option. So, but what you said though is also very true. And that, let's say, he is a contrarian oftentimes because that's where the premium is on the options. So even though a stock has gone up, doesn't mean he doesn't think that stock won't continue to go up. He's playing it where the probabilities are advantageous for him. So sometimes when you have a big decline to the downside, generally you always have a very skewed marketplace where the puts are much, much greater than the calls. You can get very far away on puts as opposed to the calls. Sometimes you got to play a lot closer to the calls. But sometimes, especially if you have a market that keeps on increasing, you can get those calls. All of a sudden, those calls can get a little bit, I won't say more skewed than the puts, but they can get better in your favor. So it's just different. I mean, it's always looking to see where an edge is. And remember, he looks at the market a lot. And that's something that I like to do personally. It's not for everybody, but I like to stay within really a few stocks that I know well, a few ETFs that I know well. I know it's not always everybody's thing. I think a lot of it has to do with my experience, because I came, when I started finance, I was a market maker at the Chicago Stock Exchange, and I did that for 7 years. And I made markets in stocks, so I was a specialist, is what they called us. So I would get, I had about 15 stocks that if you wanted to buy or sell stock, you could go to basically New York, or you could go to the Chicago Stock Exchange. And we were a regional exchange, very small, one of the smallest exchange. It's not around anymore; it got bought out. But we were the smallest regional exchange in the U.S. and primarily my markets that I made money in were utilities. And utilities are considered pretty boring for many. Sometimes it's maybe not very affectionately called this, but it's sometimes called they're only suitable for widows and orphans, because they're stocks that have generally they don't move around too much. They have higher dividends. They're kind of boring. The profitability is often set by regional governments. And so that's what I made money in. And so that's what I spent close to 10 years working on, clerking and then trading myself. So that's where I spent most of my time on. And so I felt very comfortable with utilities, and I still do. And if you look at utilities over the past 20 years, utilities it's one of the best performing groups. XLU. It hasn't moved around very much. It's got a really nice dividend associated with it. So that's something that I will do quite a bit in my own personal account, is I will buy XLU, and I have XLU shares, and then I will sell calls against it. Not a sexy strategy. It's not. But it's got kind of a nice cash flow associated with it because it's got the dividends. I'm comfortable within that area. And it is something that I will wait for opportunities. I won't always have a call in it because I do wait for the opportunities to kind of present itself. And so I will always have a call in the position, but not for every share that I have. So in other words, if I have 500 shares, I will sell sometimes 2. Nobody says that you have to offset the entire position.
Okay.
Yeah, sorry about saying that. Yeah, it is XLU. Yeah, utility ETF. Yeah.
Yeah. Okay. So in interest of time, I just wanted to kind of open it up for anyone else that wanted to ask any questions here at this point.
And I do kind of ramble sometimes, so you have to stop me if my ramble factor is kind of high.
No. This is a good conversation. I just wanted to tell the audience here that some of this may be flying past their heads, especially the new folks into the option space. The ones that have already kind of built their foundation knowledge and base here, they can understand the conversation you're having. But those who haven't will definitely at a later time, after they kind of have their conviction in learning and expanding their knowledge, they'll be able to revisit this video and understand all the concepts you shared. So I really appreciate that. So for those who are kind of like, oh, I don't get this, bear with yourself. You kind of learn. There's a lot of content out there that will kind of guide you at TastyTrade and different places to kind of speed up your learning curve in this space. So appreciate that. Of
course. And I just put a TastyTrade the newsletter that I write once a week.
Yes.
It's free. I'd love to have you sign up for it. I can also provide links to. I've been doing it for I think about 3 years, and I think I only missed like 1 week, and that's when I was like dying of pneumonia. But
don't say that.
No, I didn't. But I tried. I remember trying to write. I couldn't think that one day. I couldn't. My brain wouldn't work. But it was. I am proud of it, and I do try to present ideas. And every week I try to have something different.
Yeah, and I'd just like to add on to. I'd like to add on to that what y'all have done as a team has been phenomenal. And for those who can understand it are definitely applauding it, and I can see that. And this is like pretty much the future of trading, investing. This is, if you start grasping this knowledge, this is potential to be successful. I personally have created these consistent income trades out of this model, and it's just kind of phenomenal. Like after back testing, you kind of have a good batting average, you have a good ROI. It's just amazing to have this model in place, to kind of be successful in trading. Anyone here have questions for Dr. Data?
Let me answer one of these questions right here. Somebody asked about short-term capital gains, or well, it's actually not short-term. It's not capital gains if it's short-term, but short-term taxes, of course, taxes, there's nothing consistent except for death and taxes. Taxes do destroy all sorts of different strategies out there. And here's one. Tastyworks allows you to go short in an IRA. So it's actually one of the few accounts where you can do that. So you can do all these strategies within an IRA as long as you set the little boxes and stuff like that. And so that really does give an advantage. And Liz and Jenny, for example, I think she does almost all of her trading in her IRA. I have an IRA as well. It's not my only account, but I love doing strategies, covered call strategies within my IRA. I love it. It makes a lot of sense because the taxes are just greatly reduced and simplified. Futures. Look at the small exchange. The small exchange, those are 60-40 taxed. So it's taxed 60% and then 40%. The tax rate is 60% long-term, 40% short-term on it. So the tax treatment, thanks to lobbyists, and it is greatly advantageous to you if you're trading in just a regular account, because the tax thing can be better. But I think more of it just has to do with, are you comfortable when it comes to, what can really just destroy your account is by not taking profits. By people think that the only way you can determine whether or not you're good or bad in an account is what the overall market is doing, right? So, and I've been that way before too. The market will be up 30%, and I'm like, dang it, I'm up 20%. I wish I was up 30%. Yeah, but I'm still up 20%. Yeah, I can get absolutely wealthy getting 20%, getting 10%. That's fantastic. So why am I holding myself to this overall market comparison? You don't need to. It's what I was saying before. As long as it's within your expectations, if you can live the life that you want, if you're comfortable at nighttime, I knew people that, friends of mine, they asked me, should I be out of the market? Because I'm worried that now that we have a new president and he's an unknown, it's going to do a number on my account. And I think the market's going to go down 30%. A good friend of mine was texting me, and I said, well, I'm not sure about that, but I don't think we're going to see a lot of movement here personally, but that's just my opinion. But he had a different opinion. And so, but I said, you should do, Pete, what you want to do as far as what makes you have an easier time with things. If it makes him sleep easier at night, then I think that he should probably exit the market, or at least just offset some of it, just take some of it off the table. When it comes to things. And so I would say that's when it comes to the short-term things, is that one of the advantages that you have with options is it's just stability. That's all it is. It just helps to reduce the ebb and flow of an account, right? That's it. There's nothing really fancy about it. It's just, if you're looking at the overall market, you're looking at your account, okay? You have SPY position on. Every little bump you're feeling, right? I used to say that my happiness would go along with the market. So, the market's going up, I'm happy. The market's going down, I'm pissed off. Options can just be used to help smooth that out. So it's not quite as bumpy every day moving around with the market. When you have a covered, and look at the most easy position you can get, covered call, and you're selling calls against it, all that does is it just helps to smooth out your movements. That's it. So it's nothing super fancy.
Let's end with these two questions, Dr. Reda here. I do like these questions actually. One of them is, I guess I wouldn't go into top 3 recommendations, but
well, that's a good one.
How many, maybe if you can go through whatever recommendations you have for beginners, novice, advanced traders, and then the quant data one. Yeah.
Sure. So if you want like a recommendation for beginners, if you're purely a beginner, and when I was in high school, my dad opened up a Quick and Rally account, and at the time it was a $50 per trade. You know, so it was the commission was $50, right? And this is in the 90s and early 90s, and so but we bought a few shares of we bought about $500 worth of AT&T stock. And to me, that's the first thing you should do as a beginner. You got to jump. That's the best way you can learn about things. So a beginner is like, I consider a beginner is like having no knowledge of the market at all. Just buy just one share of something and just watch it. Just watch it for a few months. I like XLU. XLU is not going to tear it up. You know, you probably aren't going to be a Rockefeller with starting with XLU, but you can have hopefully an appreciable asset. So that's something that I would recommend is just buy one share of XLU, watch it. If you like it, buy a few more. Once you get a little bit more money in the account, try to get up to 100 shares and then just sell a call against it. That's it. Just sell one call and try to sell it at a 30 delta. So let me write that out. So if you have nothing else, and this is not a recommendation because I'm not qualified to give a recommendation, but I'm saying what I would do with my own money is 100 shares of XLU. And once again, we're not looking at the premium. I'm not looking at IV rank. That's more complicated. That's intermediate. That's advanced. This is just basic. Don't pay any attention to IV rank for this beginner strategy. 100 shares of XLU, and then sell one call out of the money. That's it. That's your beginner strategy. If you're looking to get a little bit more, adventurous, I would say go with a stock that maybe moves around a little bit more. Start paying attention to your IV and your IV rank. Look at, and I would consider this more of an intermediate type strategy, but sell, put, and call, and SLV. Okay. One of the nice things about that is it's got that high IV and that high IV rank. So I'm going to look at my platform right now. I'm looking at it on 24. Oh my goodness, it's high. And 22, I would probably do the 22 and the, let's just say 27. It's not going to take a tremendous amount of money in this particular thing. I'm not sure what it is right now. If somebody else can tell me what it is on the Tastyworks platform. The reason why I'm telling you this is because I got positions in there, and so I think my buying power requirement is going to be off.
And we'll cover that, Michael. And we'll go into Tastyworks and show them that strangle pretty much, and show them what the total margin utilization is.
Okay.
I'm a big fan of SLV because of the IV and you know the IV rank being at this optimal point up there. So
it doesn't require a ton of money.
Yeah.
It's a pretty nice way of starting. I know sometimes not everybody agrees with me on this, but I always consider things as, I like this kind of flat world type mentality of there's a lot of different ways that we can put money, and it's all about return on investment. That's all. That's all it is. It's return on investment. I have a degree in finance, right? My undergraduate's in finance, and yeah, there's a lot of finance majors out there. But one of the things that I liked about it is it just basically taught you a lot of different ways of calculating return on investment, and it all comes down to that. There's a lot of different ways you can put money. Just make sure that you can get something that. Why would I put a lot of risk in a strategy that's only like IEF if I can get about the same return in just a bond? I don't want to do that. It doesn't make sense to me. You know, I don't want to take that type of risk and deal with that headache if I can make basically the same amount of money in just some bank account. Doesn't make any sense to me. And so that's what I always kind of come down to.
Yep.
Hamza
asked you a question about, and I know this is a tricky one, but like, what is the most useful quant or data studies that has the highest probability of trade success? Like, what is now in your radar that you're looking at closely when it comes to useful quant and data studies?
More what do you mean by that?
Hamza, go ahead. You can unmute yourself. You there, Hamza?
Can you hear me?
Yeah.
Okay, awesome. Yeah. So by that I meant, it could be anything from getting a bunch of data, like a historical data, and then kind of like doing some sort of data study or quant study upon that data, such that when we get into this range, or we kind of see this trend or this pattern, it shows this movement in this stock or index, or it can be anything. It's just like what's your go-to study in as far as a given data set that shows, hey, okay, we're about to go up a lot or we're about to go down a lot with this data from what it shows me with a study done on it, and then you open a trade, a directional trade based on that, and in your experience, it's had a high probability of success. And it can be super complicated. It can be super easy. Whatever you use that works for you. Because from anything of simple, okay, these numbers are going up, to okay, I need to apply these computational or apply this code to it and kind of get an outcome.
Yeah. So one of the things that we kind of say at TastyTrade is that that everything is kind of accounted for within the market, right? So there was this kind of thought that said, if Biden was going to get in, then oil stocks were going to just collapse, and the same thing was kind of said with Trump, right? Where Trump's going to get in, and because he's having such a headache with these tech stocks were just going to collapse. And it didn't happen. Sometimes we can put so much of our own personal opinions in things, and that we're kind of like overfitting the data. We're trying to find something. We're trying to read the tea leaves where maybe you can't necessarily read the tea leaves. I think when it comes to things is look for things that are. One of the reasons why I like sticking with an area that I feel belonging to, or I feel a part of, and get a number of stocks that you want to purchase anyway, whether or not because it falls within your expectations or your belief system. Or I work with some guys that really like some of these ESG, environmentally, socially, governance stocks. They like them. I don't understand them, but they like them. And so to them, these are stocks that fit within their belief system. And so they're looking for stocks that are just down in price. And so they want to buy them.
Okay, so I get doing some fundamental analysis or kind of like looking at trends that are, looking at macro trends that are likely to play out, and then kind of buying the dip or buying some value stocks in that I definitely get that. And
be careful though about when you're talking about some of these value stocks. Be careful about that particular thing. And I also say the same thing. This is don't misunderstand what I'm saying when it comes to like buying stock. Don't just buy stocks because they have a high dividend. Don't do that.
I don't think I've bought a stock for its dividend to date.
you kind of sound too young to be buying stocks based on a dividend. But nothing wrong with buying dividend stocks. But one of the reasons why you can have this, just for everybody else, one of the reasons why you can have a high dividend is the stock is down. And so dividends themselves just tend to be, like, let's say 30 cents. It's 30 cents, 30 cents, 30 cents, 30 cents paid out, right? And they tend to kind of increase it over time, or at least in theory they do. But the percentages, if you focus on the percentages, you're focusing on a stock oftentimes that is suppressed. So sometimes people look at these stocks and they're like, oh, look at this, it's got an 8% dividend. 8% dividend is not sustainable right now. It's not. So you're looking at a stock that is down. And so unless that stock hurries up and makes an increase, one of the first things they're going to do is, because all of a sudden they're losing money because they got a suppressed stock price, and now they're having to pay out a lot of money. You're not going to be too happy paying out a lot of money. And you could also say, don't they have better things to do with their own money than paying it out to investors? So traditionally, that's always been stocks that have that are kind of like utilities and staples that pay out those dividends, rather than like tech companies that are growing faster rates. But there's all sorts of different things that you can look at. Technical analysis, so I don't really believe in so much. I believe it's already built into the stock price.
Okay.
Do I look at charts? Well, sure, I'll look at charts. Isn't that the same as a technical analysis? Well, it's just kind of looking to see where the price is, and perhaps that's my own biasness, where I go to a restaurant, and if last week that pizza was being sold for $10 and all of a sudden it's 20, I want to buy it for 20. It was $10 last week, so maybe that's perhaps
right. Technical analysis is like based a lot on like what it's showing is price action overall, right?
Absolutely.
And, yeah. Mm-hmm. But yeah, I was Mitt and Leon did a really good job of your reputation precedes you, basically, and I'm very interested in data analysis. So I was hoping, not your layman wouldn't, be doing these studies, but any studies that you can maybe shout out that I'd be able to look at that you use personally, just even for interest, even if they're not that applicable, is kind of what I was hoping to.
Well, I actually had I have a website that I built here, and you can actually evaluate different positions. I gotta remember what that website is. I gave it on a talk one day. This is let me give a second here. TastyTrade, geeks on grade. I built a website where you can go and you can evaluate different things. Oh, I gave one thing on. This is just a side issue, and maybe another time I can give a talk on this. But it's on how to do financial engineering with Google spreadsheets and doing it for free. Using
Dr. Ninja, on that, I was wondering, because I do a lot of my tracking on Google Sheets and all that. Can I pull existing data from Tastyworks to Google Sheet live data? Can I connect it?
It's funny that you say that. Not yet at the moment. We're really close.
Really close, right? Yeah. Okay.
I'm not going to tell you 2 weeks. I'm not going to tell you 2 weeks. But we are really close. Take a look at that right there. I give an analysis of how you can use Google spreadsheets as a way of pulling in data and doing a live data. You don't have to know how to program to do that. I can give a talk some other time to y'all on how to do that. But I also created a web page here and on how to evaluate different strategies. I'm actually quite proud of that page. Maybe I can give it to Mitt, and then we can.
We'll share it with the community. Hitesh, you had a question. You want to go ahead and ask that pretty quick? You there, Hitesh?
I'm here. Hey, Michael, quick question.
I think we met
I've
before.
noticed. Sorry, say that again.
I think we met before. Haven't you come into the office?
No, we haven't. But I would.
Let me chime in here a little bit. If you have seen Jeff Bezos around, he's the right-hand guy for Jeff Bezos when it comes to Amazon. He works for Jeff Bezos. So you may have seen him in videos and all that. He's a very famous guy out there. So
cool.
Yeah.
Yeah, but I've got a stash of gold bars to your office someday. For
Because there are clones of you running around in TastyWorks offices and such.
There you go.
Yeah. My question was pretty simple. We've seen this shift that's happened as a result of the pandemic from cap-intensive stocks like oil and gas and utilities to cap-light that are software consumer discretionary stocks. Do you expect that trend to continue, or do you think it's time to rebalance the portfolio to sort of buy some of the cheapies in the utility and oil and gas sector?
Yeah, that's an interesting question. I love it, actually. I wish I knew. Like, so I started loading up on oil and gas stocks. And I have for the past couple of years, not like I wouldn't say like a majority by any means, but maybe 20% of my portfolio is oil and natural gas stocks. I think it's very difficult to ever remove ourselves entirely from that, and of course Texas is a very big area. So I can understand the like of those type stocks. I don't know. I wish I did. You're right. They are extremely capital intensive, and interest rates do cause can have definitely an impact on that. And so we're seeing rates possibly going back up. We've seen the 10-year making a small increase up. Will it continue? I don't know. So that could have an impact. Eventually things will get back to normal. Some of these stocks that are seeing really unusual price movement, like a Zoom, this won't last forever. How long? I don't know. I would say balanced. But see, balance is probably the best for people individual, as a group to be balanced. But fortunes aren't made by being balanced. It's by being in a narrow group. Once again, it's what's the kind of risk that you want to take, and the kind of reward that you're seeking.
Got it.
Alrighty, and last but not the least, Amulek asked a question about doing poor man's covered call on SLV, and I would just like to chime in there. The way I determine whether to go into poor man's versus a regular covered call is based on the IVs. So if it's a very high IV rank stock, then I just focus on selling premium on those rather than buying the deep in the money call for the poor man's covered call. But on rare occasions, you'll find that. Did you want to share anything about that in terms of poor man's covered call, Dr. Data, on that?
So check this out, okay? So what is a poor man's covered call? That may be something that people would be asking. Okay, so it generally means that you're kind of poor. Mm-hmm. And you that's not true. That was a bad joke. But you're just looking to put less money into the market in order to have about the same levels of reward. It's not quite as great. The percentage return can be much, much greater. However, the probabilities are a little bit lower. So there's no perfect aspect for this, but this is generally when you would do it, is when you have this curve where it shows, and I think you gave an excellent explanation of when you would use it. I agree with you. I would add one more thing, is that the holy grail is that you are looking for stocks that have a really high implied volatility now and a low one further down, right? Yeah. So look at this, right? You got 40 back here and you got 50 here. So 50 up here and 40 here. Now that's not, you're not going to go out 800 days on this thing, but let's say you're looking out, let's just say we're do this in March, okay? So you're basically buying a stock that is, I'm going to look at extrinsic here. And so you're going far enough down where you're not paying all that much extrinsic value. And so you're buying a position that's in the money, right? So here you're basically paying 67 cents worth of premium. Oops, why do I have all this stuff here? Where would you do it? Let's just make this at, let's just say it's 20. Okay, you're paying a little bit of money here. You don't want to do it right here. So you're actually buying your call a little bit in the money, quite a bit in the money in this particular case, because you're not wanting to pay a whole bunch of extrinsic value for it. And then you go and then you sell something here, whoops. And then you're selling maybe your 24. And so you're doing this for a $320 investment. And so the most you can lose is 320. And so the most that you can make is this. So the back, because it's so far away, the decay of that option is not all that much. So it will decay. It definitely will decay, but it will decay slower. And so you only want to do this in a stock that's going up and where you don't want to put a whole lot of money in it.
Yep. Yeah, and folks here, we're going to cover that in other Saturday sessions with different examples and analyze the IVs. So we like to do that as a community group. And
I don't think I'd like it so much in SLV.
Yeah.
Maybe not. I don't think that's maybe appropriate for me right at the moment, because I think SLV is maybe a little frothy. But that's I'm so long stock in SLV, and I probably will be for a while, but I do have as many calls as I do for puts, or as many calls right now as I do stocks, shares.
Yeah, and I personally don't like SLV as a poor man's covered call because like you say, that 50 and 40, right? I like to see a more wider gap there to make it a poor man's covered call, be able to see that big differential between the IV current versus in the outer.
And we're already kind of poor anyway if we're using SLV as a proxy, right? Anyway.
Yeah, it's a cheap stock anyway compared to.
It's a cheap stock, so this is like a really poor.
Yep. Now makes sense.
I'm joking, but.
Hey Matt, I got a question for Michael. Hey Mike, so I just had a question around the recent phenomena of retail traders coming in from like say Robinhood or something. What impact has had that has had on the markets, and does IV bake this phenomena into it? I mean, when we look at IV, all that volatility that's coming in from the retail traders, is that all accounted for, or is that a new parameter now that needs to be looked at? And then baked into what we see in Tastyworks, for example.
The Robinhood mentality. Well, I mean, I think anytime you have people getting involved in the market and people that have sometimes been unrepresented within the market, I mean, that's good. I don't have any hatred for people that are using these platforms, or I would never make fun of them, because I started very small myself, and I basically Just bought. When I first started out, I didn't have any money at all. And just a little bit of things. Is it all baked into the market? I don't know. I know, like, look at weed stocks. My goodness, some of these weed stocks were the most ridiculous things ever. And they just got, had this huge increase. And now many of them, look at them now. Many of these stocks are down like 90% from where they were. And people said that, oh, this is the Robinhood trader. Well, just as quick as money can go in, money can go flowing out. And so, you know, does it add volatility within the market? Yeah, but you see it within it. You know, I don't really think it's anything new. I mean, we've always had stuff like this occur. We can't just keep the markets only accessible for people with accounts of over $1 million. You know, it's got to be.
Michael, what Mandar wants is
markets, right?
Robinhood rank, just like Ivy rank, have a Robinhood rank right next to it so that you can zoom right to it.
I'm gonna have to write this down. I like.
Yeah, well, we've seen some unusual phenomena, right? I mean, when the earnings come out, you know, if it's high or low, you know, the stock prices follow that, right? But then sometimes what we see is completely opposite of what's supposed to happen. And then, you know, then people give an explanation saying that, oh, you know, because the retail traders, the Robinhood traders are trading it one way or the other, it's causing some unusual phenomena here. So I'm just curious to know, is that all baked in, or is it something that needs to be looked at?
I think it's pretty much always baked in. Am I certain about that? No. Something I don't really like to. It seems like when it comes to the market, everybody's a genius after the fact, right?
True.
Well, of course he was gonna come out ahead. Well, of course the Nasdaq was gonna see higher growth because of such and such. You know, it's very easy to connect the dots afterwards. You know, to have that wall with all the ribbons attached to one another with the little lines between it showing that all the conspiracy theories and they all cross up to one another. But as a matter of fact, it's very difficult. I don't know. I don't know. I don't even know how I'd even start looking at this stuff. You know, I've looked before, and I heard Tom gave a good rant on that. Just look it up. You can see a rant that Tom had on Robinhood. I remember I enjoyed it. But you know, Tom's always been very positive about the democracy of the markets and having more people be involved in things. And
yeah, exactly. So that's what I was trying to say, right? You know, the democratization of that and then allowing everybody to do trading, you know, to trade options. How has that impacted, you know, the markets and primarily the IV around that, really?
Well, anytime you get more people involved in the markets, you know, you would think that you would have more efficiency within the market. But but my argument against that would be also look at what happened with the presidential election, right? Look at many of the election markets. Look at Predicted. Okay, you would think that that they would have called the election a little bit better beforehand. And, you know, there was going to be landslides in all these states. It wasn't. And some of the markets that they said it was going to be overwhelmingly in, it wasn't. And so how many hundreds of millions of dollars was looking at this, and how wrong did it get? And so it's the most watched event within the world at the time, you know. And yet it didn't seem that many eyes, it didn't seem to get it right anyway. So I don't know.
Yeah, no, this is great.
All the questions, all the things to think about.
This is great stuff, Michael. I think we're going to start wrapping up now. Really enjoyed having you here, and this is amazing discussion, open dialogue. You know, we're moving into the new world order, I think, where we need to have more of these conversations with you know, folks interested in making their headwind into you know, personal finance, right? You know, there's a lot out there to learn. It's just a flurry of stuff to learn. The more interest you put into it, the more you will learn, and you'll be able to learn how to hedge your portfolio over time.
You're
I
welcome.
actually wanted to, Michael, I wanted to end it with a video with that you haven't seen. And Tom actually shared with us back in June when he came on our group. So I'm just going to end it with that video. One of our members in this club actually asked a question, so I'd just like to share that with you and
Okay.
to the folks here in the group, and then really appreciate everyone joining here. So I'm going to share that video now.
Well, Mitt, I appreciate it for putting it together, and you know, I'm always honored that, you know, when people ask me to speak, I appreciate it. I appreciate all of it. Yes.
We love TastyWorks and TastyTrade. It's just phenomenal, and you've kind of broken the barriers of the big banks. So really
Glad to
love
hear
it. It's transforming that. Here, can you all see my screen now? Has it come through? Yeah. Okay. Perfect. And actually, you know what? Let me optimize it for video so everyone can see it. Share, optimize for video, share. There we go.
All right. So my question, Tom, first of all, thank you very much for this session. My question goes to the election day. In 2016, we saw some unusual movement, like when the results got declared, the market went down almost over 1,000 points, and then there was a slingshot. And so my thing is, what kind of trade are you planning to put in this current November election day that could, you know, blow the, you know, profit out of proportion?
So I remember the 2016 election quite well. We were doing a show that night, and then I went home and I traded until like 2 a.m. and I cried. And then after I found out Trump won, I cried myself to sleep the rest of the night. But I traded that whole night. And so to be fair, like volatility started at a much lower level. And now I think you're going to have a much higher level to start from. So I think it's going to be a very different picture. Also, I think something that should be pointed out is that right now the market is already, I'm not going to say it's accepting the fact that there's going to be a change, but if you look at the betting sites, Predict It specifically, or other betting sites like that, you know, Biden has a pretty significant lead, and there's a reasonable amount of change already priced into the market. Now, that said, I am going to treat it like it's a binary event, like any other binary event. I actually don't think we're going to see what we saw in 2016. I think that was a little bit of an outlier. I think we may, because of 2016 and because of that crazy move on election night where we dropped about 120 points and then rallied 100 points right afterwards, because of that night, I think you're going to see crazy heightened volatility. I think you're going to see puts and calls both be in the stratosphere the day before. And I'm going to treat it just like we would treat an earnings play, just like we would treat a binary event. And I think there's going to be enormous opportunity in the very, you know, far out wings of maybe selling some premium. I'm not at this point going to play it directionally because I think a lot of the direction may already be priced in by then. So listen, we're going to do a show that night, so I'm going to be talking about everything we're doing. But I feel like it's going to be very different. I think in 2016, the prices of the outlier moves were way too cheap. If you remember I don't know if you remember the option prices, but they were pricing, front month vol was about 14, 15, and back month was, the back outside wings were only like 18 or 20. And this time it's going to be like 40 or 50. So I think you're going to see a very different world. And I think it's going to be really hard to make money unless you play it pure direction, like static delta. And you want to bet up or down just based on, you know, whatever you think is going to happen. I don't think you're going to be able to buy premium and make money this election.
Okay. He nailed it. Don't you think so? Don't you think so?
Absolutely.
Yeah, he nailed it. We were just privileged to have him on and have that discussion with us. So I really admire that. And thanks everyone for being here, and look forward to continuing our journey to democratize investing. So thank you, everyone.
Thank you, guys.
Yeah.